let's look at changes done in debt model portfolio. So we keep on monitoring the portfolio of mutual fund basket that we have offered to you, and also see that whether it is in line to deliver the desired objectives, right? So before talking about the changes, let's see what has happened since this calendar year. So this budget, government declared their borrowing plan of about 15 lakh crore, and this was higher than the budget of about 12 lakh crore. That's the first thing. The secondly, expected interest rate hike by US. In India also, RBI increased the repo rate by about 90 bips in two tranches. So it is now 4.9%. Even the standing deposit facility, which is at a rate where the bank lends to RBI, it has now gone up by 90 bips, about 4.65. RBI also, sucked in liquidity from the market by increasing CRR by 50 bips at about 4.5%, and through which they have actually sucked in 87,000 crores from the market. So impact of these things, on the debt market is that yield in bond yield has gone up in last 6 months, and hence the debt funds delivering returns about annualized 3% of the portfolio, which is expectation about 6%. So if you look at the current model portfolio about having the yield of 5.6%, it is expected to give returns about 4.7% post-tax. So our objective on the debt portfolio is to deliver about 2 to 2.5% alpha or fixed deposit, right? So hence we thought that let's look at some other alternative where can we increase the yield of our debt portfolio for the fresh monies. So we actually looked at, went to the drawing board, and we looked at the other investment options, and we found the portfolio which can deliver returns about 7% over a 5-year period. So this is a portfolio which typically follows a roll down strategy. What is rolled on? Basically where the fund manager invests into some instruments and he holds on to maturity, right? So this is a portfolio which also eliminates the interest rate risk, and which also invests into 100% government securities, and hence it also eliminates the credit risk. So the portfolio which you have now invested for the fresh monies is something like this. So if you can see the portfolio here, the top 5 schemes which will not be out once you cross the 3 years period, and the bottom 2 schemes, which is a new portfolio which will deliver returns about 7.7% over a 5-year period. So for the fresh monies, we'll get invested into bottom 2 scheme, which is IDBI Gilt and Aditya Birla Sun Life Nifty SDL fund. For the fresh, the earlier investment which you have done in the debt funds, the moment it crosses 3 years, will be advised you to move that money into the bottom 2 schemes, right? So since this portfolio is now supposed to deliver returns about 7% in a 5-year period, let's see the comparison between fixed deposits, right? So if you look at the 5-year fixed deposit, a bank fixed deposit, let's say today you invest 10 lakh rupees in a bank fixed deposit, and which offers maybe 5.75% returns over a 5-year period, right? Your 10 lakh will become about 13 lakh 20,000 crores, right? And if you look at the fixed deposit, the taxation is about marginal tax, right? So if you pay in a highest tax bracket, if you pay the 30% tax, your post-tax returns would be about 12 lakh 6,000 crores, 12 lakh 6,000 rupees, right? Which means the post-tax returns of 5.75 FD is about 3.83%, right? As compared to that, if you invest into a debt model portfolio, the portfolio which I spoke about, if you deliver returns about 7% for a 5-year period, the 10 lakh will become 14 lakh 2,000, right? A debt fund, the moment it crosses 3 years, it attracts the indexation benefit, which means the indexed value of this 14 lakh will be about 12 lakh 76,000. Which means the taxable gain is only 1 lakh 26, and here you pay only 20% long-term capital gain tax, and hence your tax amount will be much lower. Your post-tax gains will be 13 lakh 72,000 rupees, which is about 6.5% post-tax. So now if you compare this with fixed deposit of 3.83%, the returns is almost double, right? And if you compare this with a fixed deposit of, let's say, pre-tax, so this is equivalent to 10% fixed deposit. Post-tax returns will be about 6.5%. So do we have a fixed deposit bank FD about 10%? The answer is no. So this particular debt portfolio is clearly a winner over fixed deposit. So if you have any of the portfolio into fixed deposit, banks or a company fixed deposits, you can clearly double your returns by moving it to debt portfolio, right? So, and if you want more information on this, please contact ARWell Partner. They'll help you out to increase the returns on your fixed asset portfolio.